You've got the idea. Maybe you've even built the minimum viable product. But there's this one milestone that takes you from person with a project to founder of a startup: incorporation. It can feel like expensive paperwork, but it's actually the moment you protect your personal assets and make your business real in the eyes of the law and investors. In this video, we're going to talk about if you should incorporate, when you should do it, and how to actually get it done. And if you want more startup tips like this, be sure to subscribe. First, should you even incorporate? Let's walk through the pros and the cons. One of the biggest pros: investors are familiar with corporations. Many VCs are legally only allowed to invest in corporations. If you're planning to raise money, this matters. Another pro is that your personal assets stay protected. If the company gets sued or has debts, your house and savings aren't on the line. And if a co-founder leaves, your corporation doesn't dissolve. The business keeps going. But there are also downsides. Every corporation needs to file annual or biannual reports in their state of incorporation. These can cost between $50 to $455 to file. Miss the deadline, you're looking at late fees of tens of thousands of dollars or more. Corporations also have hard and fast rules on nearly every facet of their business, including corporate bylaws, governance, meetings, documentation, board of directors, and elected officers. And if you don't comply with these rules, your company can be forced to cease operations altogether. So which businesses should incorporate? There are a variety of scenarios where forming a corporation makes sense. These could include startups planning to raise capital because investors require it, e-commerce businesses because the tax separation keeps things clean as you scale, and growing LLCs that are outgrowing their operating agreements. Knowing when to incorporate your startup can be challenging too. These are our suggestions, but always consult with law and tax professionals before making a decision. A common benchmark is around $100,000 in annual revenue. And another signal is when your business taxes start to eat into your personal finances in a way that doesn't make sense anymore. At that point, the structure is worth more than the cost. Ready to move forward? Here's how it works. First, pick your name. Make sure no one else in the state is using it. Pro tip: incorporation secures your name in that state, but if you want to own the brand nationwide, that's a separate trademark process. Trademarks take months. If you need to get moving, tackle that later. Second, write your bylaws. This is your internal playbook for decisions and shareholder meetings. You don't file these with the state, but you need them signed and stored. It proves you're legitimate. Third, file your articles of incorporation. This is the big one. You send this to your Secretary of State. A lot of founders choose Delaware because the laws are incredibly business-friendly and predictable. Finally, get your certificate. Once the state approves your filing, they send you a Certificate of Incorporation. Congratulations, you officially exist. Now that you're incorporated, you can get an EIN from the IRS and open a business checking and savings account. If you'd rather not handle this yourself, services like Stripe, Atlas, Clerky, or Catbase can help. Here's the bottom line. Incorporation may or may not be the right fit for your business, but if it is, just make sure you talk to a lawyer and tax professional first. They'll help you figure out what makes sense for your unique situation. Check the description for more detailed guides on getting your business off the ground. If you found this helpful, make sure to subscribe so you don't miss the next video.